In this learning objective, we discuss some of the risks associated with international investing. While international investing has its benefits, in particular through the diversification benefits that can be achieved by investing across countries that are correlated with a correlation coefficient less than 1, there are also additional risk factors that an investor must choose when they decide to invest globally. These additional risk factors include liquidity risk, information asymmetries, foreign exchange risk, and country risk. Very quickly, liquidity risk is the idea that if you're investing from the perspective of a developed country and you decide to, for example, invest in an emerging market, many of those emerging markets might have a lower level of liquidity compared with the liquidity of your home market. In that instance, when you go about investing in those global markets, you find that your risk exposure increases due to that lower level of liquidity. Information asymmetries is due to the fact that when you go and invest internationally, you're geographically quite dispersed from the heart or the source of that particular investment. And often when you do go and invest in foreign markets, there might be less information available, or it might be more difficult to go about accessing that information about the particular stock that you're investing in. That also therefore creates an additional level of risk for the investor because of that lack or difficulty to obtain information. However, the two key risk factors that we're really going to focus on in this learning objective are foreign exchange risk and country risk. Foreign exchange risk first of all. So generally when you go about investing globally, what you're going to have to do is to convert your home currency into the foreign currency and then use that foreign currency to go about investing in the foreign country. Therefore, the total return that you earn on your investment is the investment return that's generated within that foreign country plus the return that you get on foreign exchange. And because we're adding that additional layer, that additional return on foreign exchange, which can be positive or negative, what we're really doing is that we're adding a degree of uncertainty or adding a degree of risk around our total return. What's important to note that it's often difficult and in many instances impossible to completely hedge a foreign investment, so this risk is always going to be there in some capacity. So if we think about an investor that might be a global investor, let's say a US investor, and they're thinking about investing in the Australian equity market, what's their return going to comprise? Well, as we spoke about before, their return's going to comprise the return that they get from investing in this particular market. So what was the return on the Australian All Ordinaries Index across a particular year? But also what the change in the exchange rate is and whether that has a positive or negative effect on their investment. Let's give an example. One year where we saw particularly significant fluctuations in the exchange rate between the Australian dollar and the US dollar was 2009. So let's think about if you had have been an investor, a US investor, investing in Australia in that period. What we know about 2009 is that at the start of the year, one Australian dollar bought 69.72 US cents, whereas at the end of the year, one Australian dollar bought 89.94 US cents. Similarly, we also saw a substantial return on the All Ordinaries Index. The index value was 24,143 at the start of the year and 33,698 as at the end of the year. So what was the return that the investor generated? Well, let's say we've got an investor who started the year with $1 million US to invest. So they went and exchanged that for Australian dollars. Now, given one Australian dollar buys 0.6972 US cents, we can take that million and divide by 0.6972 and work out that 1,434,308 Australian dollars would be equivalent to $1 million US as at the start of the year. So they've converted that $1 million US to 1.43 million Australian dollars. They've then invested in the Australian market for the year. Now what we can see is that the return on the Australian market across the course of the year, just looking at the percentage difference in that index value, is a return of 39.58%. So that 1.43 million Australian dollars has grown to being worth just over 2 million Australian dollars as at the end of the year. So they've got a really big return investing in Australia. However, there's also a second layer of their return, which is, well, what happened to the exchange rate as well? And what we can see is that from the perspective of this investor, the exchange rate moved in their favour. Because at the start of the year, they converted their US dollars to Australian dollars, and they were had their money in Australian dollars over a year in which the Australian dollar appreciated significantly from being worth 69 to 89 US cents. So therefore, when they go to convert that 2 million Australian dollars back to US dollars, they convert it back at the exchange rate of 1 Australian dollar buys 89.94 US cents. And they end the year with just over 1.8 million US dollars. So what that means is that the total return this US investor, would have generated in Australia across that year was a huge return of 80%. Now that's partly because this was a year post-GFC where there was a huge rebound and the Australian market increased in value by nearly 40%, but also because of the substantial appreciation in the exchange rate across that period of time. Now this is an instance where the exchange rate moved favourably for the investor. Obviously that's not always the case. The Australian dollar could have depreciated across this year, in which case the end return would have been lower than the return from the Australian index. The key takeaway here is that because we've got this added layer of uncertainty, we have this added risk or greater variation in the returns. So across the course of 2009, the Australian dollar was not the only currency that appreciated substantially against the US dollar. In fact, US dollar depreciated across most foreign currencies across this year. And if we look across the period of that year, we can see that for a US investor, investing in foreign markets actually resulted in quite a substantial return for that investor. We can see that in Australia it's about 80%, as we saw on the previous slide. Norway, 88%. Similarly, countries like New Zealand and the UK. The black line here is the return they just got by investing in that foreign market. So that was the return on the index within that particular market. So in Australia, for example, the Australian market went up by 37%. And the blue line is basically the combination of the return and the exchange rate variation. Now, so we can see that fluctuations in the exchange rate can have a significant effect in the returns that are generated by an investor. Now, this particular risk exposure is particularly pertinent if an investor is not able to predict future currency movements and if foreign exchange is relatively volatile across time. So what we're going to do is actually have a look at the history of the Australian dollar to US dollar exchange rate through time. And we can see following the collapse of the Bretton Woods system, so we had a period of fixed exchange rates where the Australian dollar was matched to the US dollar. We can see then there's been a huge amount of volatility, quite big up and downward movements across time, minimum of about 50 cents, up to a maximum that was achieved in about 2011, 2012, of just under $1.10 US, but quite a lot of variation through time. So it's this variation that demonstrates to us that foreign exchange risk is a really important and substantial risk factor that investors need to consider when they go about diversifying internationally. The second key factor to consider is country risk. Country risk is the risk of investing in a country that's dependent on changes in the business environment that might have an adverse effect on the company profitability with that country and hence have a flow-down effect to the investment returns that are generated within that country. So if we're thinking about investing internationally, we want to get a measure of what is the degree of risk in that particular country that we're considering investing in. There's a couple of ways that this can be measured. One way is by looking at the sovereign credit default swaps spread. So a credit default swap spread is a security that pays out in the event of a default on a particular asset. When we talk about a sovereign credit default swap spread, that's a security that pays out where there is a default of a particular country or government through time. So what we can do is we can use the spread on credit default swaps to basically get a measure of the probability of default in a particular country. So what's the probability of a particular government defaulting on their debt? And we can therefore use that as a measure of how risky that country might be. Alternatively, analysts also provide various country-specific risk measures. So I've got here a world map that's provided by Euromoney data, and you can see that they've colour-coded the risk around the world, where Australia and the US are considered quite safe. Some African countries, quite a large amount of risk there, and through the Asian region, in here, and the Middle Eastern region across here, we can see sort of elevated levels of risk emerging there as well. So let's have a look at these measures of country risk in a little bit more detail. So first of all, as mentioned before, credit default swap, which is a way of thinking it's a market-based measure of how likely a country might be to default. So what we've got here are, for the period 2007 to 2008, obviously important, interesting period in financial markets. This is the level of the credit default swap in terms of basis points. So remembering a basis point is 1/100th of a percent, which you can think of as an indicator as what is the probability of there being a default across any of these countries. Now we can see across this time, late 2007 and throughout 2008, the credit default swaps across all these countries were significantly elevated. But in particular, we can see that for some countries this risk was elevated more than others. So we can see, for example, Greece, substantial increase through this period of the global financial crisis. And in fact, across all these countries that at the time of the GFC were referred to as the pigs, Portugal, Italy, Greece and Spain, so quite risky countries there, and we can see quite an elevated level of risk throughout the crisis. Some of the countries that are traditionally considered safer, we can see Germany, quite a low level of risk. And interestingly, toward the end of the crisis, the risk in both the US and the UK had increased quite substantially. So this is using this to track the risk. We can see that this was indicating to us that country risk in basically all countries was getting quite high during that global financial crisis period. So the alternative way of trying to measure the level of country risk is to use some analyst service. One example of this is the PRS Group. The PRS Group provide political risk services, whereby they give a quantitative measure of the level of risk across a range of categories for a particular country, and then they combine those quantitative measures together to give a composite risk index. And that composite risk index basically ranges from very high risk to very low risk, and it can be used by investors to help make informed decisions. So what does this PRS Group use when they're making their measures of country risk? Well, they divide country risk into 3 factors, and if we look at these 3 factors, it's quite informative as to what country risk actually means. So first of all, they look at a range of political risk variables. So how stable is the government? What's the risk of tension or wars within the country? Corruption and military in politics. Also, what are issues around religion, law and ethnicity? How democratic is the country, and how accountable is the bureaucracy in the country? So they rate each country across each of these measures and come up with an overall measure of political risk. Equally, they look at financial risk. So financial risk is like how much debt is the country in, what's their ability to service that debt, the country's liquidity, and also how stable is the exchange rate. So they combine those values together to get a measure of financial risk. And finally, economic risk is looking at things like what's the GDP per capita, the growth in GDP, the inflation rate, the budget balance, and the current account balance. And they combine these values together to also get a measure. Plus, then they combine all 3 categories together to give an overall composite index of the total country risk within a particular country. Now, this is just one example of an organisation that provides a risk measure, but basically it's demonstrating how they try to quantify something that of itself is not measurable, but by looking across these subcategories and giving a rating, you can potentially come up with some indicator of how risky a country might be. So that provides a summary of the risk factors that need to be considered when investing internationally.